the United States owes over $34 trillion. That's 34 trillion. With a T every second. The debt grows. But what happens if, one day, the U.S. government simply runs out of money and defaults? It's not just a scary idea. It's a real threat. That nearly happened. And if it ever becomes reality, the consequences would be catastrophic. Every year, the U.S. government spends more than it collects in taxes. The difference? Covered by borrowing, usually in the form of Treasury bonds. These bonds are bought by investors, banks, even other countries. In return, the government pays interest over time. U.S. Treasury bonds are considered the safest investment in the world. But that safety depends on just one thing. The United States always pays its bills. Enter the debt ceiling. This is the legal limit on how much the government can borrow. When the ceiling is reached, Congress must vote to raise it. If they don't, the government can't borrow more and might miss payments. We've been here before. 2011, 2013, 2023. Each time, a political standoff nearly triggered a default. So what is a default? It means the U.S. fails to make a scheduled payment, whether that's interest on bonds, military salaries, Social Security, or paying contractors. Even a short delay could shake the world's confidence. In 2011, just the threat of default caused America's credit rating to be downgraded for the first time ever. Stocks crashed, interest rates rose, and trust was damaged. But a real default? That's far worse. It would panic financial markets and trigger a ripple effect felt in every American household. First, interest rates would skyrocket. Why? Because investors would now see U.S. debt as risky and demand higher returns. Mortgage rates would rise. Credit cards would get more expensive. Business loans harder to get. The cost of borrowing for everyone would go up. Federal services could grind to a halt. Social Security checks might be delayed. Federal workers, including military, might not get paid. Markets would tumble. Confidence would vanish. And millions could lose jobs in a chain reaction that echoes the Great Recession. And the damage wouldn't stop at U.S. borders. The U.S. dollar is the world's reserve currency. Over 85% of international transactions involve dollars. A U.S. default would send shockwaves through the global economy. Nations like China, Russia, Brazil, and India, already exploring alternatives to the dollar, would ramp up efforts to move away. Global markets could crash. Currencies would fluctuate wildly. Developing countries, many reliant on U.S. loans, could face economic collapse. Even allies might stop buying U.S. bonds. America's borrowing power would shrink, and rebuilding trust could take decades. So why does this keep happening? Why does the U.S. keep coming so close to disaster? Politics. Raising the debt ceiling doesn't mean new spending. It just allows the government to pay existing bills. But in Washington, it becomes a game of leverage. One side demands spending cuts. The other fights to protect programs. And while they argue, the clock keeps ticking. The world keeps watching, nervously. Here's the truth. The United States has never defaulted. But the more we play with that possibility, the more we damage our credibility. A default isn't just about money, it's about trust. Trust in our economy. Trust in the dollar. Trust in America. Once that trust is broken, it's nearly impossible to get back. America has always paid its debts. Let's hope it always does. The story of U.S. debt goes back centuries. After the Revolutionary War, the young nation faced massive debts. In 1790, Alexander Hamilton crafted a plan to consolidate and repay these debts, building trust in the U.S. credit system. But there have been moments of strain. In 1933, during the Great Depression, the U.S. government stopped redeeming bonds in gold. This move led to lawsuits, but reflected how desperate times forced new financial policies. These moments remind us that debt management is as much political as it is economic. Real-life impacts of a default. Imagine this. A veteran counting on a disability check to pay rent finds their payment delayed. Or a retired couple living month to month on Social Security faces uncertainty. Small businesses reliant on government contracts suddenly see projects paused, forcing layoffs. These aren't just numbers on a balance sheet. They're real people, real families, whose lives could be disrupted in a default. Global ripples. The US dollar is the world's reserve currency, held by countries from Japan to Germany. Japan alone holds over $1 trillion in US Treasury bonds. China is close behind, owning hundreds of billions. If the US defaults, these countries may lose faith and start selling off their bonds. Such a move would flood the market, pushing bond prices down and interest rates up, hurting economies worldwide. Meanwhile, emerging powers like the BRICS nations are looking for ways to reduce reliance on the US dollar, and a default would only accelerate this shift. Credit rating downgrades. What they mean. In 2011, the US lost its AAA credit rating, a first in history. This downgrade made borrowing more expensive for the government and trickled down to impact everyday Americans. Mortgage interest rates increased, credit card rates climbed. Even businesses faced higher costs of capital. Credit ratings affect the entire financial ecosystem, and a default could lead to a much worse downgrade. Solutions and what could be done. So, what can prevent a default? Many experts argue the debt ceiling itself is outdated. Unlike other countries, the US has a legal limit on borrowing that often leads to brinkmanship. Some propose abolishing the debt ceiling altogether, allowing borrowing to match approved budgets automatically. Others suggest stricter spending controls to reduce debt growth, but ultimately, the solution requires political compromise and prioritizing the country's financial reputation over short-term politics. Final thought. The U.S. government's ability to pay its debts isn't just a financial issue. It's a matter of trust. Trust in America's stability. Trust in the dollar. Trust in the economy that powers the world. Keeping that trust intact is critical, not just for the government, but for every American and the global community.